Hey guys, how are you doing? Well, we are making quite a bit of progress through our course here, and we've come to a point where we've got a really big, important subject to discuss. And what I want to show you here today is I've put this out on the out on e-learning, and what this is an actual program. I hope you also have your coffee with you. This is an actual program I actually used with clients, and the reason we use this with clients. This shows the real impact of paying additional principal payments on your mortgage. Now think about this. If anybody ever approached you and said, hey, listen, I can guarantee you a 5.75% rate of return, do you invest in that? Well, given the interest rates right now, I'd say absolutely, right? But for one problem though. They guaranteed it. There's no guarantee in finance, and it's people need to be careful when they are approached by somebody saying that. So here what I've done is this is something I said that we actually use with clients. Anything in the gray, and you got the sheet notes here, is basically you need to enter your period. So let's say we're going to buy a house. Let's say the house is going to cost us $250,000. Okay, so $250,000, 5.75% our rate. Right now, probably we could get a 3.95%. So we could get that down quite a bit, and you can tell the difference. I mean, the interest rates are so important. You'll note that I said, if you ask your parents when they got their first home, my parents, this was their interest rate when they first got their home. It was 10% or a little less than that, so it doubled the mortgage rate. But now when we have something 4%, very good. So we got a great opportunity here to buy a little bit more house. So the question comes up, do we buy a starter home? Or do we go ahead and buy a home that we can build a family in? And that's a decision you're going to have to make. But the great thing about adding additional payments into your mortgage is that you are automatically guaranteeing yourself a rate of return. So if the markets are turbulent and you're nervous about getting into the market or saving more money in the market, invest in your debt. That's one of the best things you can do, because every time you pay an additional $100 or $200 in this situation, guess what? You're earning 4% because you're not going to have to pay interest on that. So as you can tell, this goes through and it will go down all the way through. Should go to 360 if everything works fine. It does. It goes all the way down. And let's take a look here. So $250,000. Okay, $1193. So what you can do is, what I want to show you is that if we go over to actual, okay, what I've done here is you see all those numbers come across, and you see that the home finally pays off at 360 periods. Okay, you know, let's say that you only got $50 a month to pay extra on your mortgage. So your payment, your principal and interest, now remember this isn't including your taxes and insurance, your principal and interest is $1,193 or $1194. Let's say you only have $50, okay, to pay extra. That's not a whole lot of money, okay, but let's say you paid that every month, an additional $50. So I'm adding that right now. Just by doing an additional $50 each month, you take off, look at that, there's only 335 periods. So you take off 30 months, okay? Just by adding a $50 payment. Now take a look at this. Now let's talk about last lecture we talked about buying a car. Let's say you do have an opportunity to buy a car, and let's say the payment's going to be $500. What if you bought a smaller car and thought of it this way? Instead of using $500 for a car, let me buy a smaller car that still meets all my needs, or a less expensive car rather. And let's take that difference. Let's say our payment's now $300. Now let's see what $200 will do for us. So we're paying $200. So we're paying $1,393.54 a month. And let's see how long it takes us to pay this off. Wow. Okay, so 274 months. Okay, instead of 360, which is a long time. So December 24 instead of, and this was the date's March 2nd, so it's a little dated there, but you could change the date on the front page. But anyway, it just shows you just adding a little bit saves you so much in interest. And for example, if I was to total up the interest we saved by adding an additional $200, it's quite a bit. So I want you to play around with this and use this at your advantage. Now I will say, if you do decide to do prepayments on your mortgage, you need to call the mortgage company and ask them if you need to do anything special. Because a lot of times what happens is you'll make a payment for $1,393, and they'll basically apply the $1,193, and they'll keep the $200 for the next month's payment. So you need to let them know you want to apply that to principal. So here is an amortization schedule, a great tool where you can pay off your home faster. Remember, I mean, if you could go into retirement without a home mortgage, I mean, that's usually about 25 to 30% of your cost during the accumulation phase of wealth. So this is a really good tool. Plus, you could also do this on any other type of loan. You could plug in your student loans, you could plug in an auto loan, and all sorts of things, and find out how much money you're going to save in interest. Hope this helps.